This is the second installment in Trading Strategy Guide's Trading Education series. In this video, we're going to talk about the mechanics of how you go about making money trading. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment. We're going to discuss how this whole trading thing works. Here's the idea, and I risk doing that whole Captain Obvious thing again, so bear with me. The way to make money in trading is simply buying and selling securities. For the purposes of this video, I'm going to talk mainly about the Forex market, but these concepts apply to most other markets as well. The way you make money in the market is to buy low and sell high, or as I mentioned in the first video, sell high, then buy low. And again, yes, you can sell before you buy. It's called shorting the market, and I'll go into more detail about that in a future video. Just suffice it to say that if you think the market is going down, whether it's a Forex pair or oil, which dropped like a rock the last few weeks, or Walmart stock or pork bellies or whatever, you will sell first and buy back later. That's how you make money when the market is going down. In some markets, like Forex for example, it's quite easy to choose to sell first. In the stock market, not so much. Like I said though, more details to follow in a later video. In the Forex market, you make money by exchanging one currency for another currency, and you either make or lose money when the exchange rate for those two currencies moves up or down. For example, let's assume you looked at a chart of the euro against the US dollar currencies and determined that you expect the euro to go up against the US dollar. In that case, you would simply buy or go long on the currency pair euro-USD. If the trading instrument, in this case the euro-USD Forex pair, is rising consistently, it's called a bullish trend or an uptrend. Conversely, if you looked at a chart and determined the euro was going to go down against the US dollar, you would want to sell or go short on the currency pair euro-USD. A consistent drop in a trading instrument would be called a bearish trend or a downtrend. Depending on your security or trading instrument you're wanting to buy or sell, there are two types of places you will trade. You will either trade in, number one, exchanges. An exchange is an organized marketplace where you can buy and sell a variety of instruments like shares in a company. An example of that exchange would be the New York Stock Exchange or the London Stock Exchange. Or futures and options. An example of that would be the Chicago Mercantile Exchange. These exchanges have been around for a very long time and over the last few decades have evolved to the point where the majority of the transactions happen electronically, which has improved the efficiency of the order matching. The second place you can trade would be over-the-counter or OTC trading. In an OTC environment, trades are made directly between two parties. All the trading activity happens through decentralized dealer networks. The world's biggest and most liquid market is the Forex market, which is actually an OTC market. That means there is no single physical place where Forex trading happens. It's all done electronically within a network of banks and brokerages that deal directly with each other. Before opening a trade, you first have to decide what instrument to trade. Secondly, you'll have to decide if the trend is either bullish or bearish, which ultimately will help you determine whether you should buy or sell. Normally, when we're moving in a bullish trend, you want to buy. Conversely, when we're moving in a bearish trend, you want to sell. Last but not least, when opening a trade, you also have to decide on your trading size, where to take profits, and where to place your stop loss. For every buy order executed, there must be an equivalent opposite sell order for a transaction in the market to happen. Conversely, for every sell order executed, there must be an equivalent opposite buy order for a transaction in the market. These two opposite orders are equal. All you need to do is agree on the price. If there's a buy order for every sell order, how do stock prices move up and down? And who decides this? These are all very legitimate questions and they deserve an answer. The truth is that there are several key factors that cause stocks to move up and down, and at the most basic level, supply and demand imbalances are what drive stock prices. The supply side is represented by the total shares that people want to sell, and the demand side is represented by the total shares that people want to buy. When the supply side equals the demand side, we have what is called the equilibrium price. Let's talk about a flea market for a minute. Well, that's what we call it in the southern U.S. You may call it a swap meet or a farmer's market or whatever. Anyway, it's a place where people go to buy and sell things like lamps and furniture and fruit and cars and gadgets and, well, you get the idea. Let's say old cousin Bob has a rare coin he wants to sell and several people are interested in Bob's coin. Well, you can expect the price to go up and up because that's a lot of demand but not a lot of supply. But what if Bob had 5 identical lamps and only 1 or 2 people interested? And then what if Miss Jane in the booth right next to Bob's has 2 more lamps just like Bob's lamps? Well, now we've got a glut of supply of these ugly lamps and only a couple of people interested in them. So the price will probably drop on these lamps if Bob and Jane actually want to sell them, or else they're going to end up taking those lamps home at the end of the day. So when there's a lot of demand and not much supply, the price can be expected to go up. But when there's a large supply and a small demand, you can expect prices to go down. Now let's have a look at a real example. Throughout this example, we'll answer a very important question. How much money can you theoretically make by trading currencies? For this purpose, we're going to look through a theoretical trade example, which will shed some light on how money is made by trading Forex currency pairs. Let's assume for the moment that you have $1,000 in your Forex trading account. The current exchange rate of the Euro-US dollar Forex pair, which is typically expressed as Euro/USD, is $1.25. In other words, for 1 euro you get 1.25 US dollars. Now let's say you forecast by some method and anticipate that during the current day the euro will rise against the US dollar. Based on your analysis, you buy 800 euros for your $1,000 initial deposit. Your forecast is correct. The Euro-USD exchange rate rises from 1.25 to 1.26, which is what we call 100 pips of movement. Being in profit, you decide to close the trade and exchange 800 euros back, for which you get $1,008. In effect, your profit on this trade is $8. Sheesh, that's not too exciting, is it? You made a whopping $8 on your $1,000 investment. So, what can I do to increase my existing profits? Well, I'm glad you asked that question. More people should ask good questions. You could invest $2,000 instead of $1,000 and make $16 profit, right? Yeah, still not too exciting. I mean, you could take your best buddy out to McDonald's on that if you don't go too wild, right? Well, what if you invested $10,000 instead? Then you could potentially make $80. Now that's beginning to sound a little better, right? But now you're saying, well, I just can't risk $10,000 right now. I got the house payment and the car payment and the kids' braces and the dog's vet bill, and we got to eat something. Okay, I get it. And you definitely don't want to use that money for trading, like not ever. I'll explain why in a future video, but for now, just understand that you never use your bill money for trading, no matter how confident you are in a trade. Remember what I said in the first video? No trade is 100% sure, and no single trade should have an effect on your lifestyle one way or another. So here's the solution. Leverage, baby. What if you could use leverage to maximize your profits? Usually if something costs $10,000, you need to pay $10,000 for it. That's just common sense, right? However, in the currency market, you don't need to have the whole price of what you're buying. You only have to deposit enough money to cover possible losses. The deposit you put up is called margin. The broker then lets you trade a certain multiple of that margin. They call that leverage. Basically, Leverage is a loan that gives you the ability to make bigger returns relative to the amount invested. But of course, that leverage swings both ways. Higher leverage not only means more profit potential, but also much larger losses. And that's why I'm constantly preaching about managing your risk. Managing your risk is the most important thing you will do as a trader, because there is a danger to lose more than your initial deposit. But just know that you can use leverage to increase your purchasing power. 100-to-1 leverage increases your available trading funds 100 times the amount of the money in your account. So if you look at our prior example, that $1,000 in your account can now be used to control $100,000 buying power. So now you have the ability to buy 80,000 euros at 1.25 with your $1,000 and your 100-to-1 leverage. At the moment you close the trade at 126 and return the loan to your broker, you are now left with a net profit of $800. Now I'm pretty sure we can work with $800 for a day's work, right? I mean, I guess that would be nice. Heck yeah, that would be nice. Okay, so don't get too excited yet. Remember, I told you the leverage thing swings both ways. If the market goes the wrong way, you could lose money too. Yep, that's the reality. As great as all this sounds, it's simply not that easy. If it was easy, everybody would be doing it, right? Remember, I told you that the prevailing statistic says that over 90% of the people that attempt trading don't make money at it. Trading is not some get-rich-quick scheme, so get that out of your head right now. You need to listen when I start preaching about risk management. It's the most important thing you will learn in trading. I promise I'll give you all the details when we get to that section. Just know that you can make money whether the market is going up or down, and you don't have to be tied to the stock market doing it. But also know that the basic idea is to buy low and sell higher. That's it for this video. Don't hesitate to ask your questions in the comments below, and don't miss my Trading Picks videos on Mondays and Fridays. And we'll be back with another Trading Education Series video next Wednesday, when the topic will be the reality of all markets. Have a great hump day, and I'll see you on Friday.